All right, well, welcome. My name is Chandler Jordan, and I am the Program Director of SC Economics, the South Carolina Council for Econ Ed. Thank you so much for joining us tonight. We're excited to have such a big group tonight and hope that we will probably have a couple of more come in as we go. You guys are in for a treat tonight. One of my fellow econ brothers from another mother is here with us tonight to present on the Federal Reserve. And he's going to give us some details about the Fed and share out his passion for economics with you all, and hopefully share some things with you that you'll be able to take back to your classrooms. It is our goal that we will wrap up by or before 8 o'clock tonight. So I just ask that you hang out with us until then. So I'll go ahead and pass it over, Keith. Thank you so much for being here.
Absolutely. I thought I was the only nerd in the house that really wanted to talk about monetary policy at 7 o'clock, but I'm happy that all of you are joining us for tonight, and I will try to keep this as interactive as possible and not bore you along the way. But I'm going to go ahead and get started because I know we're all busy. My 3 kids are dying for me to get home, and so I'm going to try to get all of you back to your families and to eat. So Chandler, I know I just shared out, but would you mind sharing this with everybody? There's a couple of places along the way that we're going to jump away from this, and I want you to be able to have this at your fingertips. So Miss Jordan is, going to drop this in the chat for you. So our mission tonight is to, I need my screen to work. There we go. Is to really look at the Fed and how we can get kids to understand the Fed, how it works, why it works, and how integral of a part of their life it actually is. So going back to standards for us, this does work into economics in a couple of different ways. I like to think about student learning and the I can statements, and this is what I want students to walk away knowing what they can do. So I based my learning target on what I would want my students to do if they sat through this lesson themselves. So I can evaluate monetary policy so that when my students watch the news, they understand and can communicate their understanding through discussion. Because I always tend to find that kids can nod their head yes or no, or they come back and say, oh yeah, I get that. And then they go and watch the news and come back with 10 questions. So I really want my students to be able to have a conversational kind of understanding about what the Fed does, how it's structured, and how are they really working within our lives. So I also like to start with a quote. This is one of my favorites about monetary policy and the banks. Henry Ford, of course, the magnate of Ford Motor Company. It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. And looking at our stimulus package and how it's being funded, if I wonder if they know. I know the buzzwords are going to be around the debt and the deficit coming up with election cycles next year. So I'm really interested that my students will know exactly what this means and how it's funded, and I hope yours will also soon. So we are going to go into breakout rooms in just a second. I think we have enough for 4 per group. Is that right, Chandler? Excellent. So little things, we're going to keep you in the same groups as we go, just so we can build some community and you all get comfortable with one another in these groups. So pretty quickly, your name, where do you teach, and how are you going to spend your $1,400? Or if you have 3 kids and a second income in your house and you qualify, how are you going to spend that $7,000 you're about to get? So of course, there is a bit of a catch to this as well. So this is why I wanted you to have these slides at your disposal. Something that our government does regularly is we monetize the debt. And so we'll use monetary policy influences to print more money in order to pay off portions or the entirety of the debt. And so is it a good thing? Should we do this? Is there really an effect that we feel as consumers? So we're going to give you all, when we say 8 minutes, we're going to give you 8 minutes to go through both of these slides in order to share out, kind of build a little bit of community, and then get your thought monetizing the debt. And we're definitely going to do this in a kind of give and take kind of scenario. So once we come back, I know everybody loves sharing out, but I'm going to ask that one person from each of your groups kind of let us know your feelings about monetizing the debt.
Just to let you guys know really quickly, I have dropped the presentation slides in the chat. If you're new to Zoom and don't know where that is, If you'll go kind of towards the bottom bar of your Zoom meeting, you'll see there's a little place for you to click chat. That'll bring up your chat on the right-hand side of your screen. And there will be a direct link to these PowerPoint slides. What that's going to do is give you the slides that Keith just went over with about monetizing and your introduction slides, so that when we throw you in these breakout rooms, you feel like you know what's going on. Is there any questions before we do that? And we'll check in on you so you won't be all lonely and scared. All right, well, I'm going to go ahead and get these breakout rooms randomly put together. If you'll give me 2 seconds.
Well, excellent. I hope all of you chose a willing sacrifice or have volunteered for tribute. I'd like to hear from at least one person from each group, if you wouldn't mind introducing yourself, and what are the pros and cons? What's the good and the bad about monetizing the debt in your eyes? And I do not have a list of what the breakout rooms were, so I need some willing folks to step forward.
I do have a list. From room 1, we had Denise, Lori, Malone, and Robert. Anybody want to jump in from that group?
I'm going to jump in. I am Lori. There was
Hi,
just
Lori.
Denise and I. The other 2 people, we didn't hear from them. So as far as the stimulus money, she doesn't know. Denise doesn't know what she's going to spend her money on. My house is under construction, so it's going to probably go into the construction cost. And as far as the second part of the task that you asked us to do with the debt, we were a little perplexed. She is ESOL and I'm special ed.
Okay.
We were a little confused on that.
No, that's great. Well, that's what we're here for tonight.
That is okay. Hopefully we'll learn something from tonight. No pressures. That is all right. All right, room 2, we had Crystal, Gwendolyn, and Vivian. Anyone from that group want to present? Don't be shy.
I think you might be muted.
There we go.
There she is.
I'm sorry. Okay. Well, we had a little twist up with this. I work, you work, we all work. I got no stimulus check. So I am down with the stimulus check.
All right.
Not 1, not 2. I invested my
Really?
money well. I worked hard for my money.
Good.
And so I see Sam getting this money, and here we go. Here we go.
Yeah.
Here we go.
You're right. Here
Uncle
we go.
Joe was good to some people.
Fair enough. Fair enough.
All right, room 3, we had Linda, Tammy, and Vicky. Anybody from room 3 want to speak for some of the discussions that happened?
I'll speak on behalf of my group. So out of us 3, no one's getting a stimulus check. So so it's weird you put us all together. I don't know how you read that well, but you did. And so we're not getting one. And then we talked about too, the responsibility of deficit spending and what it means, and the fact that there's been a lot of money put into the macro economy. And then also too, we haven't even gotten to the budget shortfalls and how we're going to need to also deficit spend to pay interest on top of interest on top of interest. So it's going to be curious to see what that looks like. And we did bring up, inflation and what type of pressure do we think that we're going to see in the macro economy, and with gas prices going up and then deficit spending on top of that, we're just curious as to see what it's going to do to the price level. But, we are living in different times. So, it could all be worth it in the end. Just time will tell.
I'm with you. I'm with you in that, and wondering what the price level impact is going to be a little bit later on. I wonder if other economies are printing at the same rate as us. Is that going to equal out in the foreign exchange market? Like, what's that going to look like? Good. I like it.
All right, for room 3, we had Desiree, Aaron, and it looks like Jeremy and his special guest.
I think this means Jeremy gets to share, right?
Yeah, I guess so. First of all, my children don't understand that I'm a teacher, but not today. Or not tonight. So that's the thing. But all 3 of us got the stimulus check, and just kind of, Aaron's going to pay off some student, Aaron's going to pay off some student loan debt. And hang on, I'm in class right now. You have to be quiet. But we talked about very quickly, like how we said the government really doesn't pay off student loan debt, but a lot of the people that in our little circle, they've used the stimulus money to pay off debt because they're in a pretty good situation. But the big thing with the monetizing the debt is just, once again, trying to keep inflation in check. But that'll be interesting as people have talked about long term. What's that going to look like later? And unfortunately, like, what are these guys going to have to suffer through? The $7,000 is good right now, but in the long run, it'll be interesting to see what happens.
Right. Thank
That's
you.
awesome. Thank you. Room 5, we had Amy, Jennifer, and Juliana. Anybody want to share?
Sure, I'll go. We talked about, typical teachers. One of us is fixing some plumbing and the other one ordered a carport. So nothing real exciting with our checks, but we're certainly glad to have them. And Vivian, I feel for you with your comments. I'm right there with you. One of my families has 9 children. So I haven't even multiplied that out because it's going to make my head explode. I just really don't want to know how that's going to go. But this whole monetizing the debt thing, to me, it sounds like our PBIS behavior system at school. I'm in elementary school. And so we have Bobcat bucks and I just run them off. If I run out of them, I just run more and I just run more. And every year I have to kind of up my prices on whatever the rewards are because there's so many more bucks floating around out there, but they're not backed by anything. So they really don't have any value. And I worry that's kind of where we're going with things and, like the inflation and the fuel, and my husband's a truck driver. So how's that going to impact our house? And, I feel like every generation thinks the next generation is kind of screwing things up and, everyone's super worried, but I feel like my father-in-law right now. I'm seriously concerned.
Thank you for sharing.
Yeah, that was an excellent way to put it. So that's a great way to think about it, even from the elementary perspective, is that we're modeling that kind of same behavior. All right, room 6, we had Donna, Nicholas, and Tamika. Anybody from that group? If not, we can go to room 7. That was Ashley, Brandy, and Sherry.
Sure, I'll go from our group. So I am getting it, and we have 4 kids. So we're getting a lot of money that we don't need. My husband and I are both teachers. We did not lose any money during this crisis. And I take away that there needs to be some kind of vetting process for who gets the money and who doesn't. Because we don't, we'll take it. We're certainly going to take it and love it and use it, but we don't need it. It's just extra money for us. So I'm with everyone else. I'm really scared of the consequences for all these people getting it that don't need it.
Sure. Hopefully by the end of tonight, we'll be able to have some more good discussion about what that means. And for me, we don't need it either. My wife's a nurse. I'm a teacher, so I connect with that sentiment very much. And hopefully when we move on a little bit farther, we'll see that maybe does there need to be a vetting system? That's a really good question to say. And what does the money really need to be used for? Is there some expectation from the government on what the money gets used for? So we'll talk about that a little bit later.
All right, we got 3 more rooms, so we'll get through these. Room 8 was Chelsea, Delianne, Erica, and Joyce. Anybody from that room want to share out? Erica?
Hey, I'm Erica, and only one of the 3 of us got a stimulus check, and I did not get one, and neither did Joyce. And we agreed we couldn't spend ours before we got it, but if I were to spend mine, I would take out trees that keep falling after Matthew and Irma. And she said that she's going to save hers in case the trees in her yard begin to fall. And then, the other hadn't decided anything to spend it on. But right now I'm working on projects for my students that have to do with Audubon and business, birds and business. And so the assignment that I'm giving them is called Deficit Hawks and Debt Junkos. I mean, junkies. So the hawks and junkos are birds. But anyway, they're going to expand upon that. But Joyce was saying that she was thinking that, we print money for other reasons. Maybe this is just another good reason to print it. And we didn't really have a lot of time to talk about the opposite side of that, but there is a concern. And I love the comparison of the print the Bob bucks and just spend it. Oh, but then I don't like the idea of upping the prices.
Very true. Yes. All right, room 9, we had Anna, Darren, and Marilyn. Anyone wants to share from that group?
In our group, let's see, as far as the stimulus check, no specific plans. One of our team members is in hospitality and tourism, and so he's looking forward to traveling and taking advantage of the stimulus check for that. I thought that was wonderful. And also another one of our colleagues talked about buying something for herself. And as far as the monetizing the debt, is it good? The negatives and the positives, we didn't have a whole lot of time to talk about it, but we talked about the potential negative impact that on the already very large national debt, and that it's only going to make it worse. So that's basically what we said.
No, that's
Thank
great.
you.
Yeah. All right, last group, but definitely not least, we had room 10, which was Annalise, Cynthia, Danny, and Tim. Anyone from that group want to share out?
I guess I can talk.
Thank you.
We on the stimulus checks, we talked mainly about saving it to pay taxes, because we're all going to get taxed on this thing anyway. But as far as the monetizing the debt, don't really have a lot to add that hadn't already been said. The only thing we really said was it's not bad necessarily for a government to run a debt, because they're running a debt for a reason, to increase employment, to stimulate the economy, et cetera, et cetera, et cetera. But on the flip side of that, when it becomes an excessive amount, that's when it can become a problem.
Awesome. No, those were great. Guys, thank you all so much for sharing.
Well, I'm going to go ahead back and share my screen if that's all right with you. We will get back to moving forward. I appreciate all of you sharing. When I initially planned this, I did not realize we had so many folks. So we're going to speed up just a little bit as we get moving along. So we need to talk about what the real purpose is that we're here for tonight, and that's really the term of getting back to the Fed and what that means for us, what our students need to know about it, and the basics about understanding the Fed. So importantly, of course, the Fed is created to help ensure that national currency is standard, can be traded amongst and between states. It is going to be a common form of currency, and it needs to be managed by a non-politicized body. That's a kind of a big thing for us, especially where everything, especially now, seems to be hyper politicized. So you'll notice that on the eastern seaboard of the country, or where most of the Federal Reserve branches are and districts are, it was created in the early 1900s. So of course, most population was on the East Coast at the time. And as citizens moved west and more land was granted west, we needed more banks out west. But the largest district is, of course, that California district that's based, that's section number 9 out there. It is a pretty large district, but relatively, they handled some of the least populous states. Of course, we're going to exclude California from being least populous. It is governed by 7 members on the Board of Governors, and each of those are going to be representative of 12 member banks. And so what those banks do is they are going to be the executors of monetary policy. And in doing so, these the 12 member banks are your printing and coining minting institutions. So if we were in class, I would have all of you take out some cash, and we take a look at all the fun bits on the bill and find out where your money was printed, when it was printed, who the treasurer or who the secretary of the treasury was, when that was printed, and it ends up being a pretty fun activity for kids. They say, "Oh wow, this was printed in Philadelphia and it was in this day," and so kids normally enjoy kind of breaking down where that comes from, and we can show them this, and it becomes pretty relatable about how money is printed and where it is and how it gets passed out through member banks and onto commercial banks where we get it. The most important of these member banks is the New York Fed. And I like to talk about this in terms of why is the New York Fed so important? And they are the most important because they are the ones who decide how many bonds the Federal Reserve banking system is going to buy and sell. So we talk about this $2 trillion, I'm going to round up to $2 trillion stimulus package that we have rolling out right now. And that is all being funded through monetary policy and selling US government treasury bonds. So it's an interesting way to look, and we will get to the finer points about that. But when I'm talking to my kids, especially my on grade level kids, it's how are we paying for this? Are we just printing money, or are we taking investments for this money? And that's how we're going to finance it over time. So I think it's important that we make those connections. So to depoliticize this, I think it's important that we also talk about the Fed as this quasi-governmental, but not bank, where the board of governors are appointed by the president, confirmed by the Senate, but then they carry out monetary policy absent of any influence from the government, or absent of any influence from the president itself. So my student will often ask, well, does the president call the president of the Fed and ask him to do this? It's like, well, he can, but he has no real inkling to do that. There's no pressure to do that. So at this point, I do want to actually, you all hopefully have all these slides. This link here is going to take you to a lesson that is phenomenal for this, especially for on-level students. So you have access to this. It's a free lesson. It is, of course, going to have everything that you absolutely need. So the links here are going to take you through the summary of the lesson, resource list, and everything. I don't want to spend too much time on that right now, but it is absolutely worth your time in diving into that resource to get back to your students. So terms are something that I think are really challenging for students when talking about the Fed. So I want to make sure that we talk about them in the simplest form possible, so that they don't get frustrated in looking at things like reserves and bonds and the Fed in and of itself, and interest rates, where I can't tell you how many times I ask my students, what are interest rates and how do they work? And maybe 1 out of 30 can tell me that interest rates are the cost of borrowing money. So it's a thing that I would urge you, as you begin to intermingle some complex issues, to break those terms down and make them as simple as possible, especially for our younger learners. I think I heard someone say they teach at a Miller Elementary School. So making them as simple as possible. I've tried to provide you some ultra simplified examples of those on this slide, and looking at reserves and how that goes. So I'm going to move on pretty quick because I know we're a little bit behind where we want to be. And here's the meat and potatoes of what tonight's lesson really is. So monetary policy breaks down into 3 policies that can be handed out by the Fed: interest rates, reserve requirements, and open market operations. And interestingly enough, just in the past couple of months, these have been used more so than they have in the last decade combined. So it's a really exciting time to be reading the news and talking about what's really going on with the Fed and monetary policy. So interest rates, if I heard right as we were going back through the introductions, is that most, if not, I want to say most of you were homeowners or in a position to be homeowners. So interest rates have been a phenomenal kind of talking piece about, well, is now the right time to refinance your home or buy a home? And so students understanding that the Fed can actually set the overnight lending rate is going to help you to connect that to home prices. or at least the interest rates on home mortgages. The reserve requirement, how about I got tripped? And Chen, you don't laugh at me for this. So the reserve requirement has been 10% forever. And I have said this 100 times in class, they'll never change the reserve requirement. There's no reason for them to change the reserve requirement. It's safe, people trust it. And so basically what the reserve requirement does is it sets the total amount of dollars or the percentage of every deposit that the Fed has to hold in cash and currency on hand in the bank. And it's been 10%. So if I deposited $100, they had to keep $10 in cash in the bank. And that was to secure deposits. And so if I demanded my money back, they had to give it to me. Well, most recently, the reserve requirement has been moved to 0. And so my question to students is, how safe do you really feel? How safe is your money in that bank right now? Are we worried? Should we be freaking out? Is it 1929? Do we all need to run to the bank and get our money? And so linking this to them in those kind of eras, because most of the time, by the time they get to a senior level economics class, they've had US history, and they can connect those 2 points and say, well, the run on the bank in 1929 was not secured by the FDIC. Do we need to run to the bank right now, even with the reserve requirement being at 0? So it's an interesting kind of play, and you can shape that discussion with your students really however you want. But I get kind of, if you can't tell, I get kind of excited when I start to talk about this kind of stuff. But it brings me back to that place of, well, the Fed is doing this for a reason, right? There has to be some good reason why they're manipulating reserve requirements, interest rates the way they are. And it flows back to that New York Fed and open market operations, because there's only so much that they can actually do to manipulate and to influence markets. So we've played with dropping the interest rate nearly to 0, which in fact, I refinanced my house. It was a great deal, and I would suspect that some of you did because of the reduction in interest rates. Then we see the reserve requirement that further expands the money supply and allows more loans to get out to consumers. Well, they finance most of this through selling and buying bonds. And so this is the concept that tends to be most difficult for students to understand, and just grasping what that really means. In a way that I've found to make a connection with this is, I don't know, but no, I'm generalizing too much. Some of our students are going to be birthed with government bonds. My grandmother gave me one bond when I was born, on the day I was born. She bought a U.S. government savings bond. It was $100 bond, and it matured when I turned 18. I got $100. It was great, plus interest. Forgive me, but I had really no idea what it meant. And so being able to teach students that bonds are really reverse loans, so we're loaning the government money for interest over time. That's the way that I tend to get that connection with them, and finding that the government selling bonds, right, is going to affect the money supply and how many loans are available for us, right? And we will make the connection between those and interest rates here in just a moment. So this is the fun stuff. All of my diehard econ nerds, we love the graphs, but this is where we need to sit for a moment. So what we're looking at is 2 depictions or 2 models of the aggregate demand and aggregate supply models. So this is the macroeconomy simplified. And this is where the Fed takes its cues from on how to apply those 3 monetary policy tools. So most simply, on the left side, you've got an inflationary gap, and that is when we're producing, when demand and or aggregate demand, meaning total demand, and aggregate supply, meaning total supply, have exceeded what we expected them to be able to be. So that LRAS stands for the long run. And what I'd like you to think about that is that's what we expect, or that's what we should be able to produce on a yearly or quarterly basis. That's what the federal government is tracking. That's what the St. Louis Fed is tracking every quarter. And in this kind of situation, we are outside of that. So producers have found ways to become more efficient. There's new resources, there's new technologies, and demand, for whatever reason, or either or outside of where we should be. And so in this kind of situation, we're looking at the Fed to say, well, are we moving too fast? Do we need to slow down? Do we need to find ways that the Fed can maybe influence the market to not move as quick or move back inwards? And on the flip side of that, and this is where we are right now. So we're in this recessionary gap. And I want to be really clear, we're not technically in a recession right now. But we are in this trend where we're not producing as much as we should or could be. And so this is why the Fed, am I drawing on that or are you drawing on that? That's interesting. So this is where we are producing right now in the macro economy. And so the Fed has said, well, how can we bridge this gap? How can we close that triangle and bring us back to where we should be producing? And so one of those tools is to enact change in the interest rates. And so if we lower interest rates, then we make money more enticing to borrow, right? Maybe now at a 2% interest rate, maybe now I can afford a new car. Maybe now I can afford a new home and get into that. Where if interest rates were even a quarter of a point or a half a point higher, maybe I'm not available to get into that. And so that's where the Fed starts making those introductory decisions about interest rates. And the same kind of logic goes with the reserve requirement. If we lower the reserve requirement, the lower the amount that banks have to hold on to, well, then they can loan more money out. And then the last is what we're seeing right now in terms of the stimulus package. The stimulus package is actually going to be funded all the way through bonds. So the government is purchasing T-bills from private banks. And in doing so, it's allowing cash. I like to think about how this works is I'm going to be the Fed. The transaction always starts with the Fed. I am going to buy bonds off of commercial banks. And when I buy those bonds, I hand them money. And that's the transaction that we see happen. And as that money hits the banks, then we can loan that out, or it can be direct transfer payments from the Treasury to citizens. And that's where we're at with the stimulus package. And the hope is you got it, is that consumers go out and spend the money. So the interesting part, and to go back to a couple of comments that we had before, we're going to go back to that in a minute. I just want to see some faces. The interesting part, and I think it was Juliana that maybe mentioned that said, I don't need the money. You know, it's kind of maybe the vetting process needed to be there. My question to you all is, did there need to be that? Or did we just need the money to be spent in order to make up the difference that we have in output? And that's really what we're trying to make up, is can we get our citizens, our consumers, to spend the money in order to allow businesses to begin hiring again and selling again. So that's really where the process comes in terms of monetary policy for this. So we are going to lead you through that is absolutely not what I want you to see right now. Holy smokes. You just saw my kids' tax information. That's awesome. So this is a process that I go through with myself and other teachers when I'm trying to figure out how can I make sure that my students know what I want them to know. I know I just talked really fast about a couple of complex things. And so I'm going to leave the chat open, but we are going to send you back to breakout rooms. I've only got like 15 minutes left, and this is supposed to take 10 minutes. So we'll see how quickly we can do this. Is creating scenarios to get your students to think about these things in practical kind of ways. Like, how can we think about what the Fed does that they can connect back to and use in your classrooms? I love all the ideas about classroom bucks and having to print more out, and does it cost more? I think that is a lesson by itself, and saying, well, I gave everybody one, I'm out, now I have to go make more. Are the ones I already gave out, are they worth the same amount? Like, is there still value? So I think that's a great place to get started. So the way that we generally do this is we find a scenario where we think about something where there's a situation that we have to make up some type of gap. We either have too much or too little, and we need the Fed to make the difference. And so we're going to either use interest rates, the reserve requirement, or buying and selling of government treasuries in order to do that. And so this is fine to do with my on-level students. I tend to use interest rates in this because most of those folks are going to be in the market for a car or something very soon. So I like to talk about cars or some type of issue within their life that they can grab a hold of in order to do that. So my example that I normally start with, and this is kind of a technical, I'm a macro teacher by trade, so this is kind of a technical piece. So a country is maintaining a recessionary gap or trend. What open market operation should the Fed enact? And I'm really looking for, should they buy or should they sell, right? That's what I'm looking for my students on that. But you can really craft these however you want and use whatever type of scenario you want. It can be a very practical personal finance kind of piece in terms of, we want to entice people to buy more homes. The housing market may be in a slump. We want to entice people to feel safe to go to college. Do we need to work on interest rates? And so all of those factors can be applied. So this is your job for the next 10 minutes. We're going to send you back into your groups and we're going to see what we can do. Chandler, I'm going to ask that you drop that folder link into the main chat if you don't mind. So this is a place where we would like your community to help build your community. So we're going to ask that you choose one person to type for you or write for you in Google Docs or whatever you'd like. And we'd like for you all to come up with a scenario. So when we talk about recessionary or expansionary, you can really change this to mask whatever you'd like it to be. I gave you a couple examples before. Do we want to entice people to buy cars or whatnot? Or do we need people to not buy cars and houses right now? Do we need to slow purchasing and slow investment? And then should that action be followed with an increase or decrease in the money supply? And how are we going to apply that, right? And then think about this, like how much is too much? Like a big thing that is really hitting the sound waves right now is $1.9 trillion is a ton of money. It is a lot of money. It is going to cause deficit spending in the future. So, is that a consideration that you want your students to have? And this last piece is a super technical piece for macro students, and we can really leave that off of your explanation unless that's already a part of your tool set. The basis of that is how money expands over time after it's dealt out from the Fed. So with the reserve requirement being 0, the expansion is infinite right now. And so that's a really interesting kind of theoretical thing to think about as we go forward. So just to be clear, your job is I'd like you to come up with a scenario that you'd like your students to be able to work through. How can the Fed positively affect that scenario? So either, I think, what was it? Excuse me, I forgot your name, miss, but I think a hurricane came through and you're removing some trees. So is there an action that the Fed can take to help after natural disasters? Is that something that you would like your young people to think about? And so how is that going to look? How does that look in terms of a scenario that you would give your students and have them work through, whether by themselves or in groups? So I'm going to stop sharing because I need to see if we have questions. I know I've just talked a whole lot. That's more than I normally like to talk all at once.
That's okay. All right. So if we have questions, go ahead and ask those now. If not, I'm going to move us into breakout rooms. You're going to go back in the same breakout room. So no need for introductions unless you just want to say hi again. But what we did is I dropped a link to basically an open folder in Google Drive. And this is a place where you guys can make a doc and kind of as a team or as a small group come up with a scenario. So you are creating a scenario and kind of like creating the question for us that then we can then solve using monetary policy. So to answer the question, Cynthia, we're going to create the scenarios, and then you can also say, well, this is one way that it could be solved as well. But again, one question as a whole group, and if you'll share it out into that folder, that's just a great place for us all to have access to some of the great things that are happening in these rooms. So any other questions before I shoot you off in those rooms? All right, all 10 rooms opening up. So you guys, we'll probably take it down a little bit, Keith. We'll probably do about 6 minutes.
That's great.
I'm gonna send y'all out. We'll see you back in 6 minutes. And make sure you stay tuned because we got a couple of things we got to wrap up with, including to get credits for being here tonight.
Please feel free to reach out with any questions, concerns, or any ways that I can help you.
Awesome. Yes, Keith, thank you so much for your time. Like we mentioned, the information that you guys just did in your breakout rooms was going to be in that shared folder. If anyone, I saw a couple of groups who went ahead and put things. So thank you so much for those of you who did.